I want to start by showing you how important ROE is. And return on equity to me isn't just how much cash flow you make from your equity, but how much total return you are receiving from all the ways real estate makes money. Let's look at the same real estate investment example as before. Let's say rents increase 125 a year and other expenses increase 25 a year. Your year one return on your $50,000 investment would be $7,500 from appreciation, so 15%. This is with a normal appreciation rate on the property's value at 3%, about $2,500 from principal paydown and cash flow, so 5% each. And these tax savings are based on if you made $100,000 in income, that would give you a return of 3.5%. So your total year one return would be 28.5% on your down payment, which is an amazing return, right? So after 30 years, the property would be paid off and appreciated to over $600,000. All your cash flow would add up to $595,000. And after all the years of tax savings, you would have received a little over $50,000 in savings, turning your initial investment into over $1.2 million. But if you look at this investment calculator and invest $50,000 over 30 years at just a 25% return, 3.5% lower than our year one return, you would have got over $40 million. So how did this happen? It's because this never got reinvested or compounded the same way a stock market investment automatically would. In the stock market, any capital gains that happen just go back into the portfolio. And then the next year's gain adds on to the gain of the previous year and snowballs. In real estate, this does not happen without reinvesting into more properties. Now, you could have reinvested the cash flow and tax savings you received, but most of this cash flow came in the later years when the rent had appreciated significantly. So it would take you years to reinvest this into a new down payment. Before that point, nothing would be getting reinvested at all. Even if you had reinvested the cash flow only, you would be leaving out almost half of your total returns in the property not being reinvested or compounded. Now let's go back to our year one returns. 20% of your year one returns go back into the property as equity. Only 8% of your returns actually get paid to you. So it's even more important to access this equity sooner rather than later in your ownership so you can reinvest the majority of your initial returns. The reason your return on equity decreases over time is because when you build up more equity, you also lose the benefit of leverage in real estate. This real estate example is compounding but at a linear rate and therefore a declining rate. Because while the value of the property is compounding, it's not compounding on your equity in the property. See, once you have 50% equity and the property appreciates at 3%, you only receive a 6% return on your equity from appreciation. Less than half of your original return when you had less equity and more leverage. The same thing if the property is paid off. You are now only receiving 3% return on your equity from appreciation.